With that, let's talk about the economy first. So I think the economy, I don't want to say has been a challenge lately, but as you look at the stock and bond market in your portfolios and everything that you see and hear on TV is about recession and raising interest rates and all of these huge problems. So I'd like to comment on that a little bit more with this slide. So as you can see here, these are the economic forecasts made by LPL. The LPL has actually reduced their forecast a little bit here recently. But as you can see, they're still fairly robust. I mean, the LPL is projecting, you can see the United States growth, right here in 2022. So they're anticipating year over year that our GDP still grows around 2%, maybe a little bit more. That's not that bad. I mean, Trump did some stuff to kind of boost the economy a little bit, with some stimulus spending as well as tax cuts. But short of that, I mean, the U.S. economy has been doing in good years 2 to 2.5 GDP for a while now. As you can see, even the Eurozone looks surprisingly good, and advanced and emerging markets. Now, emerging markets are a lot lower than they usually are. We'll talk about that. A lot of what we're doing with our interest rates is raising the dollar up quite a bit, and a strong dollar is generally bad for them. But as people talk about a recession, a recession is the common definition for it is 2 quarters of negative GDP. Well, we're there. We've had 2 quarters of negative GDP, but I know a lot of the people on this on the webinar, a lot of the names look familiar, although some don't, and a lot of people, we usually get several hundred people to watch on the replay. So I can tell you, none of our clients are really doing poorly. I don't think I've talked with literally one person this year that has said, "I'm running out of money, I can't find a job, things are really tight." I think people complain about inflation more than it actually affects them, quite frankly. Not to say that it doesn't affect anyone. I know people on the lower end of the socioeconomic spectrum, and it affects them a lot. Some of our seniors that are on fixed income, in the country, I know it affects them a lot. So I don't want to discount it, but from our client perspective, and it's our clients that are my first order of business. I don't really see our clients having that many issues so far. So it's hard for me when people say we're in a recession, and people ask me, are we in a recession? And so the Department of Labor has yet to say that we are. So technically that means we are not. But also, if GDP is growing instead of shrinking, and unemployment just went from 3.6 to 3.5% last month, and that is with 500,000 new jobs, which is a ton. About 140, 160,000 is a little closer to normal. 250,000 is usually good for the month. Last month, we had 500,000 new jobs created, and the unemployment went down from 3.6 to 3.5. If you have that, plus still pretty low interest rates and a growing GDP, I think we'd be hard pressed to say that we're in a recession. I think that one of the things that's going to keep us out of recession is spending. So I do think consumer spending is probably going to slow down. A lot of things are affecting that. People banked a lot of money during the COVID times. No one was doing anything. So all the money we would otherwise spend on going out and doing fun stuff and sporting events and concerts and trips and out to eat, all that money went in the bank, plus some stimulus money. So kind of in addition to an increased natural savings rate because of less spending for doing less during COVID, there was also a lot of government stimulus that money went right into the bank. So even though inflation is eating away at people's purchasing power a bit, also most people are getting raises, although not quite at the pace of inflation. And in addition to that, we have $3 trillion of excess cash in savings accounts and checking accounts as an American public than we had before the pandemic. So even as inflation eats away at our purchasing power, what people are doing is they're spending some of their savings. Now, people with no savings, of course, that's a problem. The people on the a little bit lower end are getting hurt, as it seems like they always are, disproportionately. And again, I definitely feel bad for them, but from our client perspective, again, I think that what's going to protect us from a big recession is $3 trillion. I mean, that's a reasonable part of like the entire U.S. economy. So I think that if you look at where people are from their debt to service ratio, which is what the slide shows, and their financial obligations, which is things like groceries and car payments and house payment and just living expenses, we are in a very, very strong position. The U.S. delevered a lot. meaning they don't have anywhere near as much debt. That's the debt service ratio as a percentage of income. That's come down a lot, like a third from the big downturn we had in 07 and 08. Because everyone that got scared of debt. So they've been paying it off aggressively. Their incomes have gone up because of low unemployment. And met this person. So their incomes have gone up, their debt has gone down, and their savings is up $3 trillion. And that doesn't include increase in the value of their stock market holdings like 401ks and IRAs and Roth IRAs. That's just cash. It's just cash in their savings account. So it's hard for me to believe that we are in a recession. Again, some people argue we are because of 2 quarters of GDP contraction, but it wasn't a lot. But we have all of these other factors that I think are keeping the economy really strong. I think one other thing that's going to help a lot is what's killing the economy. And if you've been watching my webinars at all for the last year and a half, what I've been saying is the number one thing that's going to kill our economy is interest rates. And interest rates will probably go up as a result of an overheating economy. And that would either be due to fiscal stimulus or just low unemployment. Well, we have both. Plus, we have supply chain issues and we have Russia invading Ukraine, which is jacking up commodity prices. And that has led us, when we talk to bonds, we'll talk about what's happened with bonds, but that's led us to really high interest rates, which is a huge problem. As I've been saying for a year and a half, that's going to be the problem for the economy. And I think it has been. But a lot of that stuff is getting better. So if you look at the chart here, you have ISM services orders backlog. That's just a fancy way to say, how long is it from the time that you order something until the time that you actually get it? And as you can see, that line is coming down a lot. And this is a long graph. So this is not over just a couple of weeks. This is over an 11-year period of time. So you can see that the manufacturing as well as the services backlog has come down quite a bit, like 15% already. And that's great. I actually anticipate that being down probably 25% in the next 2 months from its peak. So that means the supply chains are getting fixed. Some of that is a little bit less purchasing. During the pandemic, we switched from going out to eat, concerts, and travel to my house stinks, my furniture stinks, I need a new TV. So we went from buying services to buying goods, and there was no room for that in our supply chain. You throw in China's zero COVID policy, which shuts down entire chunks of their geographical, country as well as their economy, and our shift to goods instead of services. That really killed the supply chain, and that causes a lot of inflation. And that's getting better, and I think it will be a lot better. If you look at like PC makers, for example, they're getting killed because no one's buying computers anymore because they bought them all a year and a half ago when they realized they needed a new computer at home to work from home. So like demand for computers and a ton of other physical goods are way down. In addition to that, inflation is coming down. So I think I like this chart. It doesn't just talk about inflation, but it talks about what maybe we can look at as a leading indicator of what inflation will look like. So as you can see in blue, it's the New York Fed Supply Chain Pressure Index. And then in the orange, which is what we just talked about, and the orange is inflation, right? CPI, the Consumer Price Index. Those lines follow each other pretty closely, and it's usually the blue line that goes first. So as you can see, if I can find my cursor here, if you can see right here, right, this shot way up in COVID, right? So this said, there's some huge supply chain problems. Then they got a little bit better, and then they shot up. Well, look at what happened to inflation at the same time. Because if goods cost more, if shipping stuff costs a lot more, like 10 times more, the cost of goods is going to go up if your raw materials are going up. Well, look how much that's come down already, just in the last couple of months. So, and you can see CPI is starting to peak. The CPI number came out yesterday. It looks great. Hopefully it shows the Federal Reserve that we are in fact coming out of the hyperinflation. Hyperinflation's, Brazil at 50%. But for us, it's a lot of inflation that we had, at 8 or 9%. So inflation is coming down. The PPI numbers came out today. So that's kind of like inflation for manufacturing companies. And that was actually down. It didn't just decelerate, which is grow less slowly. It actually went down. That was a big surprise. We thought it would just decelerate, but it didn't. It actually went down. That's why the stock market's up again today. I was up big yesterday on the CPI numbers. So hopefully what that means is inflation has peaked. It's going to be coming down a bit. I mean, those of us that have gas in our cars, right, went from $5 to a little bit under $4. I think that might get a little worse here in the next couple of months before it gets better around Thanksgiving. But, I don't think it'll go up to, back up to, $5 or $6 a gallon. So hopefully inflation has peaked. As a result of that, what has peaked is the Federal Reserve raising rates. So hopefully they cool it on raising rates a little bit. And And as a result of that, the market can kind of get a little breathing room and can get back to, mid to high single digit growth here over the next couple of years.